Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Roku stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 10 billion market cap. They're trading at $68 a share, and they have 145 million shares outstanding. Roku operates a TV streaming platform in many different countries. They have two segments, platform and devices. Its streaming platform allows users to find and access TV shows, movies, news, sports, etc. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. 188 million in 2022, then it became negative 150 million in 2023, but they rebounded in 2024, back to positive again, positive 170 million. In the trailing 12 months, it grew 85% to 320 million, so things are looking up. Decent margins, they convert 9% of their revenue into free cash flow. Net income is the profit or loss on the income statements, revenue minus expenses. The only positive was in 2022. After that, big fat negatives. Revenue is sales for the company, and that goes up nicely each year from 2.8 billion to 3.1 billion to 3.5 billion to 3.7 billion. Nice steady growth, that's what you want to see. We estimated 4 years of future free cash flows. We also estimated a terminal value to total cash flows past year 4, that's 11.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.2 billion. We divide that by 145 million shares. And we get a calculated stock price of $63. They're trading at $68, so they're trading at a 7% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. Simply Wall Street's at $37. They say the stock is really overvalued. 23 analysts price this stock pretty much where they're trading at. There are 42 companies in the same industry as Roku, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't need to spend much in CapEx, only 12 million. They have the best debt to equity ratio. For every dollar of equity, 20 cents of debt. They don't pay a dividend, but I think they may start paying a dividend within the next year or two because they generate positive free cash flow, positive 320 million, which is less than the average. They rank 9th in market cap, close to 10 billion. They're trading at 4 times book value. We can't look at their PE, negative earnings. They're trading at 31 times free cash flow and 2.5 times revenue. They generate 3.7 billion of revenue, but they're growing more than anybody else. In the past 5 years, their average revenue growth is 33%. Here's their latest income statement, second quarter of 23, second quarter of 24. Platform revenue went from 740 million to 820 million. Devices went from 100 million to 140 million. A nice growth in both categories. The expenses directly tied to generating the 820 million is 380 million. They lose money in their devices division. Their expenses are higher than their revenue, which is fine as long as the profit from platform covers devices, which it easily does. Total cost of revenue 540 million. So their gross profit in platform 440 million. They have a loss in devices of 15 million. So gross profit 425 million, up from 378 million. Their biggest expense is marketing, 220 million, then R&D 175 million. G&A is about 100 million. Marketing went down from last year. That's interesting. So total expenses is lower than last year. So their operating loss is getting better. Last year, they had a loss of 126 million. Now it's a loss of 71 million. A net loss of 34 million. A lot better than last year. They had a net loss of 108 million. They had a loss before taxes of 43 million, but they received 9 million of taxes. That's why their net loss is better than their pre-tax income. Their EPS is a loss of 24 cents. Last year was a loss of 76 cents. They are adding shares. Last year, 141 million. Now it's 144 million. But it's fine to add shares as long as your earnings per share is improving, which it has. So to summarize, I have them trading at a 7% premium. I give them a ranking of 7 out of 10. Would I buy them? 7 out of 10. I really like their business model. I use Roku on all my TVs. It saves me money on my Comcast bill. Ratios are a bit weak, 4 out of 10. Financials look great, 7 out of 10. Revenue is growing each year. And besides this blip in 2023, they generate a healthy amount of free cash flow. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.